So it is a consultation. No one has to have credit pulled to know what they qualify for. They can get their own credit off Credit Karma. It's not going to be exactly what we have, but it's going to give us an idea of what range they're going to be in, and we can talk about credit, and we can talk about the things that they can do to build their credit score up, just natural ways. They give us the credit score. We know their income. They tell us their debt. We talk about what the interest rate, the down payment, closing costs, what it should look. We're packaging it and giving them a plan around how that's going to look. So no credits pulled, no commitment of money. Let's get a plan and really determine if your life event, if you are ready or you need to wait. Don't let your credit be pulled until you have a consultation with a loan officer and truly know it's the time to pull it, because it will hit your credit. Once we pull credit, it's going to take about 4 months that credit has to be repulled. So we want to look at it and say, are you truly ready to purchase in a 4-month window? That's the key. That's the question that we need to first ask, and then drill down on what's their event, what's their current situation, what do we need to do to help them have a plan to get ready and be, if they're not ready now, if it's not the right timing, to be ready by spring, summer. We're seeing a lot of that right now.
Fantastic. And most of you know, like with the market as it changes, right, that when you step into the housing market, you want to be absolutely prepared. One of the things that I love about Shelter is that they do a fully underwritten loan once you're ready in the process. And that really equips you to win in the housing market. Could you tell us a little bit about how you guys do that and approach that?
So what we just talked about is a pre-qual in the industry. So you're just pre-qualifying their criteria. The next step is them doing the application, credit pulled in, and you have a pre-discussion to get to pre-approval. Pre-approval is getting their pay stubs, getting their bank statements. Maybe we need a tax return. Maybe we need a divorce decree. Paperwork. We physically take that paperwork and review it, get it in front of an underwriter, and right then they're underwritten. We know exactly what they need to get the mortgage. So when that offer goes in for the client with the buyer's agent, talking to the listing agent, hey, our offer might be the same as the other person, but our person's approved. And that's what we want to help you do. Get as a buyer, get approved. No more fear. You're already approved. You're ready to go now into the market and get the house without that being a concern at all.
That is fantastic. And for those of you who are listening, just please contact your agent. This group of agents that have been invited to this private event are completely working in a way that really propels you to succeed and to win in this market. They understand what it takes to win, to really get you the house of your dreams. So let's pivot a little bit, Kathy, in terms of the investors, right? We have sellers, we have buyers, and then we have people that sometimes they want to invest and they're looking at the changes. How would you say that the interest rates and the conditions of the market affect their possibility of investing in real estate?
Right now with the rates a little bit higher, because an investor is going to get a higher rate. It's not going to be, what we are now. It's going to be above. Credit score, down payment, all matters. They have to put at least 20% down. And there has to be a calculation of what the typical rent will be for that home. And right now it is somewhat of a challenge to get those numbers to work. It does work though, in the right market, in the right area, especially the Airbnb income is just amazing in Atlanta right now, and even in our area, it's incredible. So the consultation with the investor is a little different, depends on if they're an experienced investor or not. Some people are taking, and I see it often, the home that they're living in now, turning that into investment property, so it's got the lower interest rate, it's got the equity, and buying the next home, and then the next home is going to be at current market rate. So a lot of the investors, depending on what type of investor, it can definitely work, depending on what they have to work with equity in their current home, depending on what their structure is. They can pull out equity and refinance right now, primary residence, take the equity out, then turn it into a investment property, take the money that they pulled out, and go purchase the next home.
Wow. So I am like even excited about the possibilities. I don't know about you, but that is just kind of like the kind of thinking that comes from somebody that has a lot of experience in the business, right? That can kind of see all those possibilities, and you having a great agent combined with somebody that knows, like Kathy, what they're doing. The reality is that you can access that possibility as well. All right, so Kathy, one thing that we heard, and I know you're going to be talking about this for our awesome agents here, but I'd love to really touch on that. Now that we are seeing interest rates in the 7s and we don't know what's ahead, and then we have had loans that, oh my goodness, they were in the 2.5, 2.8, 3%. Tell me a little bit about this word that we use in the market of assumable loan. Could you tell us a little bit about that?
Yeah, it's an opportunity that's incredible for some of the sellers. If they have an FHA loan, if they have a VA loan, then it could be assumed by the buyer. Now, the buyer has to pay the equity of the difference. So depending on what the balance is on the mortgage, what they want to get out of that sales price, that void between the two, the down payment, is that difference. So let's say $200,000 sales price, $100,000 balance. That buyer has to pay the $100,000 difference to purchase their home. They could be doing it in a sense of pulling equity out of another house, turn it into investment property, primary residence, and then have the down payment. So there's a way to work through it to get it if they don't have the cash, but they will make up cash. But you think about that. If they can purchase a home right now and assume it at 2.75 and keep that, turn that into eventually an investment property, take the home they're in investment. There's ways to work through all of that.
Wow, so definitely a consultation. I think we're gonna meet.
Yeah.
Anyway, all right, so I think that kind of really, we're doing great with our time. I really asked all of those key questions that I had. So what I'd like to do is just open the floor for all of you guys to ask some questions, and we have until 6. So let's go for it. So who wants to start first? Who has a question? Who does it have? Do you have a question from one of your buyers? Yes, Crystal?
Kathy, speaking about the options to do the assumable loan, it's a huge opportunity. So yes, it is absolutely exciting. So let's just say there is $100,000 or $200,000 difference in the equity that the seller has today. What are some other options other than tapping their existing equity, for the buyer? Can they take out a second? Can they do a hard money loan?
My understanding is that the assumable loans will not allow that.
So
It's a servicer question though. So if you have a client that has FHA or VA, they want to know all their options. You need to get with your client on the phone with their servicer as a realtor, as a service, to understand what that will allow, that servicer will allow. Because if it's a bank or a credit union versus just a large servicer, it might be different on what they will allow. So again, the servicing department, your buyer will need to talk to the servicing department, or your potential seller, buyer, let's get with who their mortgage company is and get on the phone and ask those questions. We've got a potential buyer, we're about to market this. We want to know if a second mortgage is allowed. If a seller's second is allowed, if any type of second is allowed, hard money, like Crystal said, what are the options, and that is going to depend. Most of them will say no, from my understanding, but I would always ask the servicer on what they will allow, because times have changed, and it continues to change, and they may be open to doing that.
So based on what you just said, it's essentially cash to close for the
Correct.
difference. Unless there's other options with that
Right.
servicer.
Correct.
Thank you, sweetie.
Fantastic. Donna, Pat?
Kathy, I have a question. A lot of our buyers now, they've seen interest rates at high 2s, 3s, 4s the past few years, and now we're at 7, and they're like, wow, this is a really high interest rate. Can you talk about what that rate looks like historically?
Sure. So historically, the 30-year fixed rate has averaged over the last 30 years 7.25%. And that rate actually that we've seen in the last 2 years was completely attached to the pandemic. It had the Fed at that time, the economy had to be stimulated. The Fed was buying that rate down. We were of course, all paying for that. But it was being bought down to keep the market open and the market stimulated. That is only going to happen again if we have another pandemic or some type of tragedy with our nation, that they've got to again take government money to continue buying and paying down that rate. It hurts, you know, if you look at that and you're used to seeing this over the last 10 years below that. Again, I've been in the industry since '83. In 1983, I did mortgages at 18%. People bought homes. Now, house prices were different, income was different, I get it. But over the cycle that I've been in this, when we went below 10%, I was in shock. As being in the industry so long, I'm like, oh my gosh, we're going below 10%. Kept creeping down, kept creeping down. Couldn't ever go below 5. I'm like, there's just no way. So it's all mindset of where you've been. You've got to learn from history. You've got to look at it that way. It's like, we will not have, against unless there's another tragedy, anything below 5 if you look historically. Even to get down to 5, that is a big deal. We've got to have inflation and everything in check. There's got to be a platform that's perfect. Again, 7.25 has been that average for 30 years. And unfortunately, I think we're going to be in that range. Hopefully, as you know, we talked earlier, down to the 5 range next year. You're going to marry the house, marry the home, have that 7% rate, and refinance out next year is my opinion.
Fantastic.
Thank you.
All right. Anyone else has a question? What are you seeing, right? What are you think about the buyers, the biggest concern? And by the way, when you guys think about a question to ask, and so I remember when I joined, when I came into real estate back in 2000, I was selling homes. It was a buyer's market, okay? The buyers were like, it was candy. I was closing, I think, averaging about 5 homes a month, all right? And I was maxed out with buyers, which is amazing, right? An amazing experience. And we were closing at 8.2 on an FHA.
Yeah.
And it would, we couldn't keep us if you had a house on the market, the house would not stay on the market long enough. It was somewhat similar of the drive that we have seen in 2022. So all that to say that it's a matter of perspective, right? I think that we tend to forget that when, back in 08, 09, when we went to we call it the crash in real estate, that's when we started to see, like you mentioned, Kathy, like the help of the government, when I believe it was President Obama at that time that brought the HOPE program,
Right.
and they were refinancing and all of that, and we saw those rates of 2-3% to help the nation, but it is not sustainable. It's really
Right.
not sustainable. So as the market grows, our first attempt is to think, oh my goodness, what's happening? But an appreciation rate of 20% per year is just not sustainable. Nobody else could buy a home, and eventually we will, not be able to do anything. So, anybody else? Yes, Crystal.
Kathy, can you talk to us about long term? So for people who've never owned a home, this is overwhelming to come from a low rate of 2% up to 7%, possibly 8% before the end of the year. Can you talk to us about why it would make sense to take advantage of acting now versus possibly waiting? I know you spoke to the sense of use that money to do a buy down for tenants, but most tenants don't have $24,000 laying around. So for the average first-time home buyer who's saying, I would rather continue paying $2,000 a month rent versus buying now because of all of the concerns and fears that I'm hearing, what would you say to that particular home buyer?
Well, the first thing is you have to have somewhere to live. And unless you're living in your parents' basement, rent-free, you're paying rent. The rent's going out the door. You're going to have somewhere to live. So if you have a home that you're paying $2,000 a month, sorry, I had a cold in my throat. If you had a home that you're paying $2,000 a month versus rent that you're paying $2,000 a month, you're committed to pay your rent on time long term. You're committed to the home long term. You're not committed to the rate. So my thought is always, it's of course their decision and what they're comfortable with. You want to make sure that they know all of their options. But rent is 100%. It's not tax deductible. If we look at their income, which we will, comparison, $2,000 a month in rent, no interest deduction, $2,000 a month in mortgage, maybe $1,500 of it interest deduction. What does that do for your taxes? So if you're not paying Uncle Sam $400 a month because of the mortgage interest deduction on your W-2 any longer, can you put that towards your mortgage? You can. You can even change your W-2 withholding to get it back monthly versus waiting till the end of the year to get the $4,000 or $5,000 because of the mortgage deduction. So you've got to look at the whole picture, and that buyer needs to understand it. Again, it is emotional, it's your home, but this part of it, we need to look at the numbers. The emotion comes later when you find the home and you fall in love with it and the contract's signed and you're closed. Right now, the pre-qualification to get ready is financial. We've got to get the financial numbers, the worst case scenario, throw away rent, don't have mortgage deduction, 100% interest versus I'm not moving back to my parents. I'm gonna have a mortgage or I'm gonna have rent. Let's have a home.
Yes, Ebony, and then
So piggybacking off of what Crystal said, for those first-time home buyers, because for some people, having $10, $15, and $20,000 just laying around, it's unrealistic. So being that rates are going up and things of that nature, will there be any new programs that are implemented to help that first-time home buyer where the credit is great, the income is great, but as far as the down payment and the closing costs, that's where the hiccup is? How do we help those people get to the closing table?
Well, there's a lot of programs out now. I mean, there's Atlanta Housing Authority, there's the Georgia Dream, there's Cobb money, CAB money. If they qualify for down payment, they still have to have closing costs prepaid and escrows, which can be asked from the seller. So again, structuring it that way. A lot of time at this point, I like to talk to people about their income tax refund. Let's get ready for that. Let's have that money ready for the purchase of the home. You can take out of your 401k as a first-time home buyer and borrow your own money. Add those two together, and most people with possibly a down payment assistant have enough money to buy a home. We can get it structured. Working, as we work together to negotiate with the listing agent, this buyer needs you to have the seller pay $8,000, closing costs prepaid and escrows. We've got the down payment covered. They've saved a couple of thousand. They're getting $4,000 from their tax deduction, and they've got $2,500 they can pull out of their 401k. So there are ways to get there and help them think through how to actually even change withholding now, start saving more money, and get ready for the spring market. But yes, down payment assistance is still out there. We can do it. And sellers now, where they weren't maybe in the market 6 months ago past, we're not open to having that as much. I think they are now.
I would agree with that. And Ebony, on that note, and I know you do that with your clients, that consultation, as she was mentioning earlier, is just key to find solutions, right? So I know you're a solution-driven agent, to really know what the possibilities are. When we are just not opting into that, there are just like so many resources available, right, to get you there, either credit repair, talking about your taxes, just a framework of possibilities. So,
and there's actually 100% money out there. We don't have it at Shelter, but what I do in my consultations is make sure they know if they have the credit score, they're in that right income bracket. There are credit unions and there are banks that still have 100% money. And there's NACA, it takes a while, but I've got someone right now, I sent them over there. I said, it's gonna take long, but you need NACA. This is gonna get you in a home. And that's what we're gonna do in the consultation, is even if I don't have it, as our partnership, we're gonna help them know where and how to possibly get the money and help lead them to someone that'll have a different conversation because they have a different program to work with.
yeah, thank you. Hang on just a second. Heather was next, and I'm coming to you, Kim.
So what I'm hearing from one buyer that I was working with is they're concerned because they're hearing the interest rates going up and they know how much they're qualified for. And as interest rates go up, that might reduce the amount that they're qualified for when they're looking for a purchase price for a home. So what I'm hearing you say is right now there's the potential that the seller might be willing to help purchase some points to kind of keep their market.
Right down where they want. There's another thing that we can do. So the seller can buy it down for them, you know, with the 2-1 buy down or a permanent buy down, just paying points to buy it down. The other thing we're about to come out with is a 90-day lock that has a float down option without a property. So they're going to be able to lock in for 90 days. If the rate goes down before the house is under contract, they're going to be able to float down. And we're about to announce that because we realize that's part of the market is a little bit of the fear is getting out there and continuing to watch the rates change, finding that perfect house, but the payment doesn't fit anymore. So we are about to come out with that, and we're working on that. And I know that I've heard some other lenders already have it, like a 60-day, not gone up.
That's really good news.
Yeah.
Thank you, Kim.
I just wanted you to explain from your last question that you answered about NACA because some consumers may not know what that acronym stands for.
So NACA, N-A-C-C-A, is a program that the banks have to invest in. You know, it's part of their requirement by the government. I don't know which banks. I think Bank of America. There's another one. Who's the other one? Does anybody know? Are investing in it. NACA is a program that's 100% financing. It's a lower interest rate. It does take a while. There's classes. You know, there's hoops that they have to jump through. But for someone that you look at their situation and go, wow, credit score's kind of low. The income that they're sitting at is really going to be tough for them to save money. They're in the income bracket, you know, it makes sense. I would refer them to NACA and I would tell them at that point, you know, I really want you to go look at this. This is what you can be doing to get this up and work through it. But if I can get someone in the home faster because it's going to take them so much longer to save or get where they need to be through a program like that, that's what we want them to do. They can, you know, they can still pick their agent. But it really will make sense for them to look at the program and just know it might take 6 months to get through it, but they're going to get a lower interest rate
Thank you.
and no money down.
Just to piggyback on that, I took a NACA class yesterday.
Power agents in this house, man.
Have you done it too?
So what they were saying is that NACA is a consulting firm that helps you get into the mortgage with the banks that are working through their program. So a lot of people confuse NACA as a lender.
Not the
a
lender.
lender. They work with the lender to get you
The banks.
pre-qualified.
Yep.
In advance to kind of work through everything. And so they have in-house agents, they have agents that they refer people to, and any agent who wants to work with their buyer to go through NACA, there's a way to go through that too. So there are 3 ways agents can work with NACA and buyers.
It's a really interesting program because the buyer then has to commit to actually come back and help teach classes and work through it. They have a lot of great classes to go through.
So you have to be certified to either refer your client there
No,
or
there's
No,
no
not at all.
certification.
no certification.
No.
All right, who's next? Go ahead.
For those that are considering buying in the near future, can you just touch on the basic requirements that will be needed for them to even obtain a loan?
Yeah.
FHA or conventional?
Yeah. So we first have to, of course, have a job. You know, have to have the income, and there are certain criteria around that. Again, we have to look at, do they have cash down payment or not? You know, that would put them in one bucket or another bucket. What their credit score is. Like right now with us, you've got to have the 620 credit score range to get a loan. With a conventional loan, you have to have at least a 580 with FHA. So we have to look at that mid credit score too. Again, talking with them in first, let them pull Credit Karma, see where they are, that can give us a range and see how they're close they are. We have to know their debt, you know, debt to income. So we have to look at what debt they're exposed to, student loans, car payment, credit cards, compared to what mortgage they're potentially wanting to have. And we have to look what that number is compared to their income. On an FHA, you can actually buy a home with the house payment, car payment, credit card debt, up to 56% of your gross income. 56%, not net, bring home 56% of your gross income. On a conventional loan, it's gonna be about a 45% rule. VA is gonna be in the 50s with good credit. So it's credit score and credit base. Like someone could have one credit card for a year and that's it. Have that 620 score, that's fine. That will work. Looking at the credit score, looking at the debt to income ratio, looking at their job. So, you know, salary job, hourly guaranteed, even if you just got out of college, just became, you know, out of a student, and you got a salary or a guaranteed hourly, we can close on a loan the day you get the paycheck, your first paycheck. You don't have to have a 2-year history. In an employment, you could have the 2-year history that worked into, you know, being a student. If someone's self-employed, 2-year history, and self-employed means a lot of other things, like it's someone that maybe it's a 1099 or a W-2 that's on a contract, you know, a contract worker, 2-year history. You know, those are the things we have to look at: income, assets, credit, debt, you know, and look at all of those numbers together.
So both of you have tremendous amount of experience, so I think it would be perfect for you to address this. You may not be able to, I'm putting you on the spot, but looking back in history, 30 years experience and thereabouts, if someone bought a home in the last Great Recession and that person still owned that home today, that was a time that, like now, when we're dealing with uncertainty in the rates, correct? Would that person have made money or lost money if they still owned that home?
I think that may be a question for me. So generally what we see in real estate, it is an appreciation, a continued appreciation over a period of time. Even when the house prices go down, as we saw, I've been in this market and I've seen 2 recessions and 1 crash. And so even when they go down, they will go up higher. And really, if you think about it, look at what's happening now. Look at what happened with 2020. It's the same kind of principle. The market corrects itself. However, overall, we see that I think we have about maybe 30 years or more of data that really shows. So what's going to happen is for those people that are on the fence of really whether they should buy or they should not buy, you know, getting in the market at this point will guarantee that you over time will get more equity. This is personal for me, but one of the things that I love about real estate is the fact that any one of us can opt into buying property and really start the process of accumulating wealth. Or, you know, and wealth to me is financial freedom, right? It's not really about the money, but it is that journey. So I think that question ties into that, and I have seen prices with my own homes, my own experience, but even back in starting in the 2000s, that, you know, if you look, you really are never going to be able to get those prices back in there. I mean, even with 2 recessions and 1 crash, right? So what goes up, comes down, but overall, real estate is one of the safest investments. It's tangible.
It's a long-term
It's
investment.
a long-term investment. If you ever wonder what has happened in the last probably about 7 years, I think this is data from the National Association of Realtors, nationwide, up to 30% of most homes were purchased by what we call iBuyers, institutional investors. What do you think they did that? They totally are banking on the real estate market. So if they're going to do it for that, why not our buyers?
So what I hear you saying is we buy real estate and wait.
That's right. We buy real estate and wait. We don't wait.
We don't wait to buy.
That's right. Exactly.
Yeah, it's very rare that you'll talk to anyone that could have bought a home 5 years ago, 10 years ago for investment, whether it's their primary residence and they didn't, or investment. This is, wow, I wish I would have done it then.
That is
Wow, I
absolutely.
wish I would have done it then. I can say property. Why? Why did I sell it? Why didn't I keep it? So again, long term. You know, long term. If someone's only looking at keeping a home for a year, 2 years, 3 years, 5 years or less, and they know that, that's a whole different conversation. Most people are what, 7 years still in a home, 10 years. But again, you know, the investment versus throwing away in rent, that's all I can say.
Thank you, Kathy. Ebony?
So just to jump back a little bit, what does purchasing a home look like for a business owner? Not 1099, but they own their business. And how is that debt calculated? Is it just basically the business debt as well as their personal debt? Is it a combination of both? And is it state specific? I know there was a lot.
So a self-employed person or a business owner is a self-employed person. But if they have a business, a S corp, you know, corporation, LLC, we're going to look at those business tax returns. We're going to look at the personal tax returns. You've got your gross income, maybe K-1s, you know, 1099s flowing money through, and an analysis has to be done. Depreciation can be added back, mortgage interest can be added back. There's a number of things off that bottom net number that you see, because a lot of people look at their net number going, wow, I'm never going to mortgage. There are things that can be added back. If that doesn't work, we have a self-employed, almost a stated income. There's a 1099 program that doesn't look at tax returns. There's also a program that we look at 12 or 24 months of their personal deposits or business deposits and do a calculation off of that. So a self-employed business owner, 1099, non-W-2 person, there are other alternatives versus just the conservative model. Again, CPAs tax are amazing and they help us not pay taxes we don't have to pay, but some of that does hurt in a mortgage, but there are ways to get around it.
In conjunction with Ebony's question, so that means though, regardless if you're using 1099 or if you're using their payment deposits, it's 2 years. Is that what I'm hearing?
You've got to get a self-employed business owner, 1099, non-W-2, you have to have a 2-year history.
Okay.
Now, there is an exception. If someone has been in a business, and I'm trying to think of one that works, for 6 months, you know, let's say a year and a half maybe, hadn't done full 2 years tax returns, year and a half, but before that they were in the same chiropractor, example, worked for another chiropractor, was a W-2, had their own clients, moved a year and a half ago, so they don't have a full 2 years, so they only got 6 months of 1 year tax return, another year about to be filed. If it makes sense, we can make that work because they've been in the same industry. Their flow of cash has gone up since they went self-employed away from that. We see that a lot with chiropractors and dentists and professionals that maybe started with a company, they were in an IT company, now they have their own IT company, not quite 2 years, but we can make it make sense on the income then versus the income now.
How would that piggyback on with someone coming out of college going into their industry?
Yes, salary W-2, they're gonna have to be on the job. They're gonna have to start the job before closing. But they don't have to have a 2 years history of employment because they've got a salary or they've got a guaranteed hourly at a guaranteed weekly amount from their company.
Thank you.
So they can buy typically does it take 2 weeks to get a check to start on a job? Within that 30-day window of starting their job, we can close their mortgage. We've had people come out of college, into finding a home and making it work that we close the day they start and get a paycheck later if they have a guaranteed income.
That's really amazing. Yes, Nadine?
Question to you, Kathy. I have been working with this buyer, and he's recently been diagnosed with disability and getting out of the VA. How viable would he be for a mortgage? He's a first-time homeowner.
If he has long-term disability confirmed from VA, we can use it.
Okay.
He's got to get a first payment in hand. We have to have his VA, letter, and he's not going to have a VA funding fee, so that's going to be awesome. And we do love to work with the veterans. I've done it for 39 years. We really, really want to thank them for their service, and I'll do that now live. Thank them for service, and would love, any opportunity. And again, the disability income, whether it's VA or whether it's, pension, Social Security, disability from another source, as long as it's long-term, we can use it.
Okay, thank you.
Fantastic.
Now, Kathy, will the baby boomers possibly need to stay put and go into a fixed income? Does shelter have anything as far as a reverse mortgage for them?
I don't do the reverse mortgages, but I do have a referral to give them to that's an expert at it, and that's all they do. But yes, the reverse mortgage is an excellent program for someone in that position. They can take it out as a lump sum, they can take it out as a monthly, and as long as they live in their home, they don't have to do anything with the mortgage the day that they move out of their home, whether it's in assisted living or by death. Then their family has to deal with it, pay it off, buy it, sell it, pay it off, or let it go. They're not exposed to having to keep the mortgage.
And just for clarification, so the reverse mortgage is for someone that has the house either paid off or a huge amount of the equity is available, correct?
Correct, because there is a calculation that has to be done. Again, they have to be of I don't know exact because I don't do them anymore, a certain age. Over a certain age, they have to have a certain amount of equity. There will be an appraisal done, and then they'll be told you have this much equity out of the house. You can actually purchase a house with a reverse mortgage too. There's a way to do that. So anyone from reverse mortgage will get you to an expert. We'll get them to come in and do a class.
That's right, that's right.
Yeah.
So now I have a question. So what about like if I have a mortgage and I want to pay the mortgage fast, right? Like I hear all these things. You send one payment, send two payments, send four payments, 15 years, you drop it 6 years. What is it about that I can actually do?
So when you have a mortgage, the amortization on the mortgage is scheduled as if you pay the payment the first of every month. Not the second, not before, not after. The first of every month. If you set up a bi-weekly payment so that the mortgage company is paying it, pulling it out twice a month, you're going to have to get 2 weeks in advance, and they'll help you with that, of paying the mortgage. Then they're going to take it out. So you've got one mortgage in advance. They're going to cut the payment in half. It's going to come out twice a month. And it's not an exact number, but it's pretty close. On a $500,000 house, you will save about $100,000 off the life of the loan on a mortgage.
Wow.
Just by doing that.
And paying it off in 15 instead of 30. Wow.
It's actually
Wow.
20
20.
instead of 30?
Yeah.
Okay.
But also, the bi-monthly is bi-weekly is a perfect option. Paying an extra payment, paying your mortgage always 2 weeks early. Because the key is the interest is only being charged on the balance you owe. So if you pay it 2 weeks early, your balance drops, the interest off the principal balance that day. So therefore, every day after that, 2 weeks ahead of time, you've lowered what you're paying on the interest because you've lowered your balance already. So just pay your mortgage 2 weeks early every month.
So one more time. So you want to get with your mortgage company and pay your full month in advance.
Yep.
And then from that point, set your normal payment. Say it's $2,000 a month.
Yep.
You're going to pay $1,000 biweekly.
Yep.
So you're
That
still just
alone-
paying, you're still just paying
One payment a month.
It's just that you're breaking it up in two payments, and you can take a 20-year loan and cut it down to, a 30-year
30
loan
on and cut it down
to
around
20
20.
years.
100,000 interest easy. I
That's
mean,
powerful.
it's amazing what you can do just to help with your mortgage. I always say I give my mortgage a Christmas present. I pay extra mortgage every Christmas.
I guess that's why we call this class mortgage hacks.
That's
Yeah.
right. That was a hack that was worth, what is it, $100,000 in a
Yes.
$500,000
Yes,
home?
yes,
I'm
yes.
for it. All right, guys, we are approaching our time at 8 minutes. So what other questions do we have for Kathy? I'm so excited that we have it all for all of us. So, yes.
So for people who are looking to, again, I have a couple of first-time home buyers, when they're looking at lenders, the information that you just shared, is that state specific to whereas if they were go to another lender, let's just say the person lives in New York, California, wherever, would it still kind of be across the board
As far as what?
as far as the
We've talked about a lot.
as far as the qualifications for someone who was looking to purchase a home?
No, unfortunately, especially banks and credit unions, they can have overlays. So Freddie and Fannie, FHA, VA have their rules. But every lender and every servicer could add a rule. If they feel like they're not comfortable with it, then, you know, especially if it's jumbo, they may add another rule to that. So every lender's not even. Every lender doesn't have the knowledge to be even because there may be some little thing that can be done legally to get their mortgage, but the lender is the lender's knowledge that's going to have to know the guidelines and have the history, you know, of how to change things, do things, you know, consult with them on what the options are. And the question should always be asked, does your company, does your bank have any overlays above the loan? You know, is there anything extra that you're going to have to make me do that maybe another lender doesn't do? And they should be truthful and tell them, well, actually, you know, some banks right now will only go to 640 on a conventional loan or 620 on an FHA. So you need to know. You need to know, you know, why. If someone says I wasn't approved and they said I couldn't get a loan, ask them the question why. Call me, tell me why, and I'll say, well, that's an overlay. They need to talk to someone else, even if it's not me. They need to know that there are other possible options if that's the only reason they were denied.
Please explain the overlay.
An overlay is the mortgage company or the bank or the credit union adding a rule to what FHA, Fannie Mae, because FHA says 580, we'll accept 580. A lot of lenders won't do a 580 loan. They're hitting it at 620, so that's an overlay. That company has said we don't want to do an FHA under 620. Same thing with conventional loans. Some lenders are still at 640 versus Fannie Mae and Freddie saying 620. VA is 580. VA is 580.
All right, guys. Who else has some questions? Yes.
So on the overlays, would it also be the DTI?
Yes,
Okay.
yes. They can have overlays on any avenue they want to have it. It may be, you know, some silly things. Like there's some guidelines out there that they put on. I'm like, who made that one up? You know, and added it. But overlay is just an additional criteria that they're going to require because that's just their rules. That's their guidelines.
And the beauty of it is because we're working with Kathy, you know all those overlays that those underwriters are requiring
Exactly.
ahead of time.
Exactly.
So would this be the reason why using a lender that is local would be best for someone who was purchasing a home over using
Rocket Mortgage.
I don't know the name. One of those
A spaceship company? Is that what
bigger, yeah, spaceship company.
My personal opinion, and the reason I'm not in a bank or credit union, again, 39 years of doing this as a direct lender, I don't have to have overlays. It's direct Fannie, direct FHA, direct VA. Local underwriter that I can physically talk to about their situation. A local appraiser that lives in the area they're appraising. They live there, they know it, they're gonna call the agents and have discussions. They know the area. You know, if you're not working with a local lender, you're working with someone that may or may not know all the details about how the state of Georgia fees work. Most of them do because it's in their system, but they may not have an underwriter or a processor, the people that are attached to getting that loan closed, a closer that they can call and get on the phone because of their broker situation or bank situation where everybody's, you know, maybe they're originating out of Georgia, but they've got all their operations in California. You got a time difference. There's a lot of reasons why I'm a direct lender. I've done it all. And drilled down on being with a company that's local with everything.
Wow, that is really significant. Okay, guys, we're 3 minutes. Yes, please do. 3 minutes.
So what states are is Shelter Home Mortgage in?
Shelter Home Mortgage is licensed nationwide. Yeah, we've got JVs nationwide. Our parent company is NewRez, which is one of the largest servicers in the nation. We also just purchased last year, NewRez purchased Caliber. So we have Caliber Home Loan nationwide. So we're actually close to the largest wholesale and retail lender in the nation. So we're local, but we've got a big presence nationwide. So we can help anybody in any state. I can connect them. If I can't do the state, I can definitely partner and get someone involved that's local in that state.
And I'm going to say, in terms of like that qualification and so forth, being in the business for a long time, it is so critical for a buyer and for a seller to be well informed and have resources, because we can, you know, for a buyer, you don't want to really step into the game and not be fully equipped, because unfortunately you won't be taken seriously by this market, right? So having somebody that knows, understands that can kind of take you, not just like the pre-qualification, but she's even offering, let's get in a journey, on a buying journey that can help us to get you to where you need to be. I think that is absolutely priceless. We are 2 minutes towards the end, so if we don't have any other, do we have any other questions? And then I'd love for Kathy to share how people can contact her for, you know, her gracious appearance here. So anybody else has a question for us? We're good? We cover it all? Wow, this is amazing, you guys. This is really, really amazing.
Kathy, you are amazing. Thank you.
Thank you. Y'all are amazing.
Thank
So
Thank
your
you.
best way to get
Question.
me is to get you, the realtors, to connect us, because we're in partnership together. And what I tell the buyers, realtor and mortgage for life. No matter how long it is, since the time we're talking today, if it's 10 years from now, you're going to be in my phone, you're going to be in her or his phone, and we're going to take care of you.
I can vouch for that. You actually sold my brother's home in 2004. I have a colleague from Keller Williams in Winston-Salem. She's asking, are you licensed in North Carolina as well?
I have a partner that is.
Great.
Yay, awesome. Okay, Kathy, so would you mind telling people how they can contact you briefly, and then I'm gonna close this and
I'm
later
telling them to
Adrian-
call you realtors.
All right,
That's-
okay,
that's-
well, I missed
You
that.
know, us, yep, call them, text them, and let's get together as a team, because that's the only way it's gonna work. You know, we have to be a team. We got this as a team, and we're gonna work together to have your best interest, not only during consultation period, but going to the contract. We're gonna be working in tandem with the listing agent to make sure your offer is in the best light of that listing agent that they present to the seller, and or the seller, if you're selling, we're gonna help you understand all the options that you need to have to make your house the best option, but we do that together.
Excellent. Thank you so much for participating. Please call your agent and contact your agent to get further information, and we hope that we serve you well. Thank you. All right, guys.